My name's Christine DeBacco. I'm a corporate partner at Fenwick & West, which is a technology law firm, and I work with companies from formation through to exit, and also with venture capital investors and strategic investors. I'm going to let my panelists introduce themselves, and then we'll kick things off.
Perfect. Hi, everyone. I'm Nicole Quinn, a partner at Lightspeed Venture Partners. We're a $1.2 billion fund based in Silicon Valley, enterprise and consumer. I spend my entire time in consumer, so looking forward to the valuation discussion today.
I'm Dana Settle, and I'm a co-founder and partner with Greycroft Partners, a venture fund based in LA and New York. Started about 12 years ago and currently manage just over $1 billion. Both core, we have funds that are core early stage funds that focus on Series A as our sweet spot, but do a little bit of seed investing out of that as well. And then we have a growth fund that's really Series C and beyond. Both B2B and B2C, I also tend to focus more on B2C. Also looking forward to the valuation discussion. I wish valuations would come down, but maybe that's just me.
Sure. Rory O'Driscoll, Scale Venture Partners. I want to start by acknowledging the obvious, which is it's odd to be the odd man out on this panel. And what I mean by that is, of course, that I focus mainly on enterprise software. My two colleagues to the right focus on consumer, but I'm sure we'll work something out.
Great. So we actually had a very similar panel here in this room last year, so almost exactly a year ago. And I think the general conclusion from that panel was markets are very frothy, deals are very competitive for investors. And I think we're sort of feeling like not much has changed. So let's talk a little bit about Series Seed versus Series A. I think the data shows that years ago there were like 3 seed funds, and now there are over 1,000. So lots of dollars going in at the seed stage, but many of those companies have trouble then raising a Series A fund. So how does that dynamic impact the valuations and deal landscape in the last year? Dana, do you want to kick things off?
Well, I think what seems to have happened is that increasingly the seed round really is what we used to think of as sort of the Series A. I mean, that is sort of the first almost institutional round, and the seed rounds are typically now like $3 million or $4 million, and so I don't know. I mean, when I started in the business, that was not a seed.
Yeah.
And so, I think that's what really has changed, and so the valuations in some ways are, haven't changed that much, sort of in that general round. It's just that the round sizes have gotten bigger. And then at the Series A, which really, I guess you would almost think of as like what used to be sort of an early Series B, probably
like 5 to 10 million or something like that.
Increasingly they're like $10 million, and therefore, again, the valuations have gone up there, but there are fewer Series A deals done relative to all of the seed deals and seed activity that's happening. I don't know if you have a different.
Yeah, I mean, it's exactly that. I mean, I think, I would have said 10 years ago our typical deals are Series B. The last 3 deals I did, 2 of them were Series A. And it's not that we've changed what we do, it's just that, there's different letters. And I always say, the business doesn't know what letters on the stock certificate, right? So, we do companies when they got $1 million in run rate revenue and they're starting to scale, right? And we've seen deals that have had, the seed 1, seed 2, seed 3, and they've raised $8-9 million, and now it's a Series A for 10 to 12. So that's definitely a phenomenon. And I think that's just as you got all these seed funds, you got to put it somewhere and keep the companies alive longer and maybe get to an A. And the valuations, I would say, a little bit of disagreement. I would say they're not as crazy as it would sound when you say I'm paying 30 pre for a Series A, because it's really a Series B. But at the same time, they are like the Series A today, at times are as expensive relative to revenue, more so than a Series B, 10 years ago.
Used to be,
right?
Yeah.
It ain't cheap. It's not as stupid as it sounds, but it ain't cheap.
Yeah. And in answer to your point about the sheer number of seed VCs, I think you said 3 back then, and now there's over 1,000. That's really creating an issue in the industry because there's roughly the same number of Series A's being done, but multiples of the number of seeds being done. And so as a result, the percentage of seed companies that are actually going all the way through to being back to the Series A is a far lower percentage. And there's great relationships that later stage funds like ours have with seed companies, so we still want to speak to the seed investors, but we know that there's just a lower percentage that's going to continue to be done, and I don't see that changing anytime soon.
It's a great time to be an entrepreneur.
Yeah.
I mean, it's a great time to start a company. I mean, at least start one and sort of get that
things
first
going.
company
Right.
done. I think that the challenge with that, though, is that it also dilutes
Effort.
effort.
Everything.
Yeah, and so all of a sudden, whereas it used to be that you would have really high quality, founding teams because people would jump in and join a team. Now they're just saying, well, I'm just going to start my own. And so it does dilute the effort, and I think that is going to be a bigger issue.
Yeah, I think it is because everyone, I mean, same as LPs, everyone always asks about valuation, and candidly, the valuation impact is much less important at the stage any of us play at than the phenomenon Dana talked about, which is I would prefer to slightly overpay for the leader in a non-competitive market than get a great price, even for a good company in a 10-way horse race.
It's not a good price.
It's not a good price because that's my point, is that you just, competition, what I said to my LPs is, you asking about valuation, I'd prefer to talk about competition, right? Is that any business that has 10 competitors is definitionally almost a crappy business. So this whole dilution of effort is a real pain. And it's, I think it is a bit of a tragedy of the commons situation. But, Mr. Market will take care of it, but it'll be slow and painful.
Right. Okay. Let's talk a little bit about the consumer deals that are being done out there. I think this is an area where people seem to think it's extremely competitive for many investors, and many of the e-commerce companies we're seeing can have meaningful revenue, maybe even get to profitability without raising much or any venture capital. And so, what are your thoughts on that? I mean, it seems like the money has to be very, very attractive for founders to want to do the deal. How are you seeing that reflected in the deals that you're looking at?
So I would say, and this is perhaps building on Rory's point as well, there are a lot of consumer companies being started up, a lot in the exact same space. I think like the categories around the company that Roman is in, it's like you see one company start and then there's so many other competitors, very much like the mattress space. And it's difficult because you have to essentially figure out who is the number one. And that's definitely a lesson that we've learned. Never back the number two in consumer. Always back the number one. But right now there's so much in terms of just the dollars being put to work across all of the competitors that it becomes like a marketing race. And it's just a matter of like who can spend the dollars most efficiently, who has the most dollars to put to work.
We should just all invest in Facebook. I mean, because that's where all those dollars are going.
Yeah. And that's definitely not going to change. And they can keep changing the algorithm whenever they want.
Yeah.
Yeah.
But sorry, I didn't mean to.
No.
Yeah.
And then also to your point on the consumer side of things, a lot of the e-commerce companies, and I spend a lot of time in e-commerce, are profitable by the time they get to Series A, which is the main stage that Lightspeed tends to invest in. And by that point, they don't really need money. And there are definitely many businesses that don't need to raise money, and that's absolutely fine. Not every business should raise venture capital dollars. But for some of them, they do want to bring a partner to the table. They do want to work with somebody who has seen this many times before and knows what the next roadblock is going to be, but they don't need the money. And so then in that case, a lot of these term sheets, increasingly so, have a secondary component to them, and earlier and earlier. You seeing the same?
Yeah, I mean, for sure. And I think, again, it's just a function of competition. And at the end of the day, I mean, and look, I don't think anybody has an issue with founders taking some capital out of the business, but it's a question of when. Mm-hmm. And, how do you make sure that incentives continue to be aligned, especially at those earliest stages? And, I mean, I think it's one thing for a company to, I feel like there's like big inflection points in business. One thing to go from sort of 0 to 10 million in revenue. It's another thing to go from, sort of 10 to 50, and then, sort of 50 and beyond is a whole nother, stage, and then 100 and beyond is sort of a whole nother stage. And, I think a lot of people get sort of false positives and think that because they've gotten to 10 million in revenue or they've gotten to 50, that it's, like it's done. They're going to be a success. But in this day and age, it's actually relatively easy to do that. And so, in any given market space, there are going to be 5 companies that jump in and that can sort of get to that, get to that level quickly. But that doesn't mean that they're going to succeed long term. And the reality is that even, as sexy as direct-to-consumer, businesses are, there is a trade-off. And, as you scale, you do have to continue to spend more on marketing and spend on brand and probably build out physical. And so it's not like it's going to be capital intensive.
Yeah, that's where I wanted to go, because I don't do the consumer side, but I questioning the basic premise of the question. We'll come to founder liquidity in a second. It's like, all these companies are quote unquote profitable, but are they? I mean, everyone gives this, oh, it's so cheap to start a company. Look at the frickin' paid in capital when they go public, with the exception of Stitch Fix, which is just awesome.
It's cheap to
right?
start.
Agreed. That's my point, is that
yeah.
they say, oh, we don't need the money. Well, other than the 50 million in marketing it's going to take to get from 10 to 100, we don't need the money, and the physical warehouse, and all these companies that don't need money seem to take an awful lot of it.
But
right?
Rory,
So, right? And I don't know what they're doing, but it's like just from a distance, maybe they're head faking us. Maybe, like we don't need the money, but we'd really like to take 50 million on 200 pre. Yeah, okay. So
when you say with the exception of Stitch Fix,
yeah.
I just really believe that there are going to be a lot more Stitch Fixes, and we're already starting to see a lot more Stitch Fixes.
That'll be interesting.
That are getting to 100 million in revenue, having only burnt less than 5 million in capital.
Well, and that's where, I think the reality is that we are in a unique point in time where a startup does have an advantage relative to a retail incumbent, just by not having to have that level of investment in physical infrastructure, and to be able to be so much more efficient as far as having data about your customer and really understanding what it is that they want, and being able to have more efficient inventory. There are lots of things that you can do today, starting de novo, that are very difficult for an incumbent to do. So I think we are in sort of that unique point in time, which is why a lot of dollars are flowing in. But if too many dollars flow in at too high evaluations, then...
In other words, if nothing else can screw up their businesses, we will. Right? We will give everyone enough money to spend against it, because that's what will happen.
And if we don't, SoftBank will.
Exactly right, and who are we to judge? That's right. Blending all 3 questions into one. Sorry, we're off.
That's why I love being on panels with Rory.
Go.
Let's drill down a little on the founder liquidity, because I just think it's really interesting. Years ago, we were seeing our founders do maybe a little bit at a Series D or Series C even. But I feel like that has moved down to Series B. Even I can think of a couple of our clients, Series A companies, where the founders have taken some money off the table. What's the right stage, and how much are people generally comfortable with founders getting liquidity on?
So
Controversial question.
yeah.
What does right mean? Who are we to judge, as the pontiff would say? Wasted on anything except the Catholics in the room. But, it's a serious comment. What do you mean by right? Like, the point is, if they can't, there's no, it's not about the right answer. The real question is, how do I feel about it relative to my investment, right? And,
Exactly.
I think more often, it's interesting how often it's positive, because it's hard to contemplate a DA, because you can't give the speech about, I've done 4 years in the wilderness, I've ground it out, we've got to 10 million in revenues, I've paid myself peanuts, my spouse is saying correctly, we're signing up for another 5 years when we take your capital. At that point in time, I think it's totally reasonable to consider it. The sacrifices folks have made to get to that level, there's a modicum of money that's larger than one would want to admit in the great American Midwest, but it's a quantum of money that's not unreasonable if you're trying to live in the Bay Area, for example, right? So I don't get overly judgy as venture capitalists managing billion-dollar funds, being paid reasonably well, if some dude wants to take money off the table after 5 years, eating ramen noodles because he wants to, buy a house rather than rent.
Yeah.
So there's a lot of it that it's not totally awful. Now, there are also some egregious ones where you go, we may not be aligned anymore. The question is, it's about alignment going forward.
Well, and also I think every case is so individual, because it really, that to me is the key, and that's how I feel about venture capital in general. I think we try to make it this whatever one size fits all, which it is not. But if you have a founder, founders have different motivations, and you can have a founder who has never made any money and has put so much time and effort and energy and needs to take a little bit of money off it. Great. Keep going. We want them to be focused and keep going. I think equally you can have a founder who's made an insane amount of money, and still it's sort of it just depends on what's, and still want to take a little bit of money off the table just because they feel like it's the right thing to do. And it just depends on what motivates that individual person. And I think that's what our job is to really understand that and try to keep those.
That's a great point. And just coming at and the proof of that point is the following sentence. We all talk about how we love to back successful repeat entrepreneurs. Let me give you a clue. Successful repeat entrepreneurs are rich, right? And we're not saying, oh, I'd like to back you, but are you really hungry anymore? You know, if you want to back, it's very person dependent. So it's very good.
Yeah, we always ask the exact same thing. What motivates them? And also, sometimes they're taking money off the table, not just for themselves. Like, I often see founders who want to take money off the table so they can buy their parents or grandparents a house. I don't think that is going to reduce their motivation to make this a huge business in any way. So very much independent, like case dependent.
What about related to that, the broader liquidity programs where it's opened up to all current employees or some subset? What are your feelings on that and the right stage and time to do that?
Again,
As part of a financing transaction usually.
later on. I mean,
That's
it's
a
more of
later
a thing
thing.
later on.
Later, yeah.
You know, again, exposing, of course, the whole discussion, the inaccuracy of the stock-based comp doesn't really count comment, but leaving that to one side, if you are holding on for 7 or 8 or 10 years to go public, there is this issue, the classic issue that we face in many companies is, early stage person, great for the first 5 years, you need to transition that person out, they've got a half a point of vested stock in the company, they want to exercise, and then you tell them, well, it's a 200 grand check, oh, and by the way, it's a $3 million tax hit. What do? Say to them, and if you don't exercise in 90 days, we're going to take that
for your
stock
help
back.
for the last
Thank
3
you.
years. Yeah.
That's wrong. And then we've had board meetings where we've gone to the mat on that and said, we've got to do something. That is wrong, right? Because the other solution is we'll extend everyone's options term until the end of time. Doesn't work too, because then there's no retentive effect. So the only thing that works if you live in the United States and have to pay taxes is you got to have some kind of structured program. And that's the logic for a lot of these, and I think it's totally fair.
Yeah, and it seems to be the
Especially-
quid pro quo for the transfer restrictions. I feel like that's
Yes.
sort of how companies
That's
think about
exactly
that.
right.
Yeah.
You can't get your head around the transfer restrictions unless you do it.
Exactly. Okay. As you're thinking about, which companies are interesting to you and what good deal terms are, how do you think about companies managing and balancing profitability versus growth? That's a sort of classic thing that I know founders struggle with. Do you think about it differently depending on the industry or the unit economics of the business? Where are things at right now?
I had some interesting debates on this last week because I was in London, where they think very, very differently about this to America, and I think America thinks very differently to Silicon Valley about this. And so my view is, like, fine, if you're profitable, it's obviously a great position to be in. If you are profitable at the expense of growth, then I would prefer our companies to are on the latter side. And it's interesting in terms of, like, the best companies that I speak to are the ones that, fine, have the ability to be profitable, but are staying around that break-even point. Because then if public and private markets do start to dry off, then you still have the power in that point to be able to move to profitability and be self-sustaining and not need investors. So you have that power, but you are still just skating at that break-even point where you are then able to keep putting the money back into growth and keep driving the business forward. So those are the companies that I get most excited about. I don't know whether you guys are seeing the same
Rory,
thing.
is that different in the enterprise world, do you think?
No. I mean, everything Nicole said I agree with. And to just put a finer point on one part of it, right? The Europeans are chokers. We can say that. Yeah, it's just like you just go over there and you go, really? You're not playing to win. What chance do you have? But the comment about growth and profitability, if you can get, the truth is this, and we've talked a little bit about this in the past, is that if you go below a certain growth level and you say, well, I'll get profitable, I'll slow down growth, I'll get profitable, and then I'll get more capital and I'll start growing again, that's just not true. It's super hard once you're X growth to attract venture capital at great valuations. You'll get venture capital at valuations that reflect your current lower growth rate, right? But what you won't get, what you'll have given up is that ability to attract the high premium that makes it worthwhile for everyone. So it's unfortunate because what it means is you end up in this bifurcated world of, for great economics, I'm going to grow fast and I don't burn a lot of cash because I've got great customer economics. Lucky you. That would be what's called a good deal. You should pay up for that, right? Most of the time, I've got okay customer economics. They're good enough on an NPV basis, but they consume cash. And you face the choice. Do you keep cranking at high growth, running the risk that at any time, if you need money at the wrong time, you're screwed, or do you throttle down to a much lower growth rate, but at least have a more manageable capital need. The problem, and that latter sounds more conservative, but the problem is once you've done that, it's super hard to step back up and get capital at an attractive rate, right? And if you can be profitable and stay profitable and grow, fine forever. But if you need venture dollars, we're in the business of financing growth. If you're not selling growth, we're not investing in you. That's just the way it is.
But at the end of the day, I mean, you have to have, like, there has to be a good underlying
Model.
and, or at least you have to be able
Yep.
to convince people that there are. And, you know, I think that's what the sort of best founders are able to do, is to paint that picture. Because, of course, day one, it doesn't look perfect. But, you know, if you have a great value proposition for your customers, whether it's a, you know, B2B company or a B2C company, where you have very low churn, you have great retention, you have repeat, you know, purchasing. I mean, like, that is going to make for an attractive model. And so if you keep pouring money in, then the growth will continue.
And it's hard to see that. I mean, because remember that dude who published in 2001 that, you know, the bonds, the Amazon bonds wouldn't get repaid? Because you can say, at the moment, the economics are tough. But the wider insight was the lifetime value of all those consumers was awesome, right? It's hard to know if those models work, which is why venture capital is hard, right? But the reality is, unless you play to win, you won't win.
That's a great note to end on.
Hence why Europeans are fun.
Thank you, everybody.
Did I?
Thank you.
Cool.
Thank you.